Good morning from London. I'm Anna Edwards alongside Guy Johnson and Kriti Gupta. We're an hour away from the opening trade. Here's what you need to know. The Senate passes a temporary funding bill that could end the 41-day government shutdown with a vote in the House set for Wednesday. Donald Trump confirms that he's working on a deal to lower Switzerland's trade tariff and that his administration is close to a trade deal with India. And we'll bring you breaking UK wage and unemployment data shortly, and we'll discuss what it means for the Bank of England and its rate path ahead.
In the meantime, quick check on these markets. The outperformer, marvelly likely to the data that we just saw across the term. We'll dive into the details in a moment, as Anna just said. Showing up in the FTSE 100, almost 0.8% higher is the outperformer. But still, green on the screen when it comes to Euro Stocks 50 futures, $1 at 115. Keep an eye on the Swissy. Maybe this is something that could finally thaw when it comes to a relationship with the United States. We'll dive into all the details. The countdown to the opening trade starts right now.
Good morning. Tuesday the 11th, Armistice Day here in Europe, Veterans Day over in the United States. Obviously, we're going to see some bond market closures a little bit later on in the US. We'll turn to the UK gilt market in just a second, but yesterday's session was amazing. Big bounce in tech. Did you see what happened with Nvidia? Did you see what happened with Palantir yesterday? Palantir was up 8% yesterday. Huge move. That's what we've got to think about as we come into today's session, which I think is going to be dominated by a series of data out of Europe, particularly the UK, as we prepare ourselves for data out of the United States, maybe by the end of the week. But let's focus firmly on what is happening here in the UK this morning. The pound is down.
Yep, the pound is down. Seems to be responding negatively to the latest wage data that we've had out of the UK this morning, Guy. I'm drawn to looking at some of the wage data this morning. So private earnings, excluding bonuses, dropped from 4.4% to an increase of 4.2%. Now, that is entirely in line with expectation. But that was where Bloomberg Economics was looking for confirmation that we were seeing moderation in the labour market. And there are other signs of weakening in the very imperfect data that we have around UK labour. So the unemployment rate has ticked up more than had been expected. So it was at 4.8%. It's now at 5%. The estimate was 4.9%. So that's more than expected. But some attention might go to the other things like claimant counts, jobless claims, because of the imperfect nature of some of this data.
The Bank of England is on a knife edge. We've seen that with the latest call, the latest decision on rates. Very tight. Is this data enough to sway the governor, it seems, actually maybe in the direction of a rate cut at the next meeting? And maybe just at the margin it does, and maybe that's what the pound seems to be responding to.
Yeah, perhaps, because there does seem to be a lot of indecision about whether the market is expecting a rate cut in December. Bloomberg Economics was leaning towards no, but saying there is this risk that with a weakening labour market, that gets brought forward. And so maybe the market is expecting more from December as a result. Almost
2 weeks away from the UK budget in the meantime. The countdown continues. We should talk about some of the other pieces of data or news that's crossing the terminal. The shutdown.
We might get some data.
Yeah, we might get some data on Friday. Valerie Titel was here 24 hours ago, being very excited about potentially getting non-farm payrolls on Friday. We all kind of dismissed it. Maybe she was right.
Well, no, she said we could get it this Friday, next Friday, and the Friday after that, which would be like a party.
Payrolls Palooza is what we're calling it. The shutdown is really interesting. The narrative has shifted. There's a vote coming on Wednesday, according to some House members. If the vote happens, Donald Trump is due to sign it, and the government reopens again until January 30th, and then we get to do this all over again, which is very fun. But I think the data piece is so crucial here, because now that we are starting to get perhaps some momentum on reopening the government, we get the data, we get the economics, we get the back pay. We also potentially get some clearage on some of the air cancellations and the FAA air traffic and all the concerns there. So it's not really moving the markets today, but maybe that's because it was in the price from yesterday.
Yeah, maybe that's the case. I mean, maybe they've all been watching, maybe all the analysts on Wall Street have been watching Valerie because they seem to agree with her about how quickly we might get some of this data. Morgan Stanley saying that we might get it within days. Deutsche Bank also saying that this is the lesson from 2013, that it takes a few days to get probably the September non-farm payrolls report. But BMO and others saying it could take weeks to get some of the other data sets. There's a lot less clarity on whether we get those.
Felt like a good excuse to buy tech stocks yesterday, didn't it? Big moves, huge moves in terms of what we got around some of the main names that we watch. Nvidia +6.
And interesting that SoftBank is selling its Nvidia stake this morning. We'll let the team dig into the meaning behind that. Maybe it's all about the timing, but Nasdaq futures down 0.1%.
Precisely to the point. I don't think it doesn't look like a sustainable by the dip kind of move that we are getting here. Maybe there's some sort of concern around maybe the House not clearing it first time round in terms of the vote that's scheduled for Wednesday. Don't know. Going to have to wait and watch the politics around that one. You've also got some really big catalysts coming up. Like, you're going to get the data. you've still got the Supreme Court, and Trump is railing against the Supreme Court at the moment. You've also got what is happening in terms of Nvidia numbers coming up, Tuesday into Thursday for us next week. And there's a lot of things still happening.
Yeah.
It doesn't feel like the coast is clear for these markets just yet.
It's definitely not clear. You mentioned the tax piece, but if you look at some of the other movements that came, it's next to gold stocks, it's next to healthcare. This is very much a defensive trade in the market.
Okay, let's talk about Switzerland. Switzerland is notionally neutral, but apparently has some big guns. And those come in the form of billionaires, which can be deployed to the White House.
Not where I thought you were going.
Yeah. And they've succeeded by the looks of things. It looks as if we are going to get a deal for Switzerland that is going to take tariffs down from 39 to around 15%. So you send over the boss of Rolex and all these kind of companies to the White House. Trump apparently, well, he does. He wears a Rolex. I think he's got a Patek. He's got various other Swiss watches as well. So maybe this is the right crowd do you want to send. And they seem to be delivering at the moment. So you wonder what happens with Swiss assets on the back of this. Do you get a boost to Swiss assets on this news that we are going to be heading towards 15%? Because apparently the meeting was highly successful.
Yes, and it does seem as if something has shifted in the narrative, and President Trump giving us that impression. I mean, I would just caution, as many in our Bloomberg reporting have done, that we kind of got here on August 1st. And then that fell apart. So we'll see whether this has more legs. Maybe the billionaires will make all the difference. India also in the mix, though. Looks as if we could get a substantially lower tariff on India. Trump saying we're pretty close to a deal there. He's happy with what they've been doing with Russian oil, which seems to be part of, in the Indian case, unlocking access to at least that conversation.
But again, to your point, this has been highly volatile, this relationship, over the last few weeks and months. And things seem to change very quickly. And we get towards a deal and then it gets kind of snatched away from us at the last minute.
And you mentioned the Supreme Court. We're still waiting. That, of course, is end of this year, beginning of next. We get a verdict there. But President Trump is really upping the stakes by talking about what America is set to lose, in his view, if he gets an unfavourable ruling from the Supreme Court.
He did it over the weekend. He did it last night, overnight for us.
He's worried.
He's clearly worried. And you look at the betting odds, and they are suggesting that there's a 1 in 4 chance that he wins. A 3 in 4 chance that he doesn't win.
And he's not just focused on what it would mean fiscally, you know, the amount of money that the US would have to pay back to countries that they've claimed, or you know, whoever they've claimed these tariffs from. But he's also talking about the FDI that has either been transacted or has been promised, and whether that might not materialise, or the investment flows that might go the other way. In his view, at least, and so he's putting the bill at $3 trillion.
The problem is, though, that he's making the case for this being a tax.
Yeah.
Every time he talks like this, he's making it sound like a tax, which is
not what the Supreme Court will let him do.
What the government lawyers told the Supreme Court this was. So he's kind of almost undermining his case by making some of these points that he's pushing out there at the moment. Let's talk about what's coming up on the show. Aaron Captain's going to be joining us, the Global Head of Economics and Strategy Research at UBS Investment Bank. He's going to be talking to Francine very shortly at the UBS conference, and we'll get his take, maybe on what data we are going to get. Gilles Roth, Luxembourg's finance minister, is going to be joining us on set, as will Helen Jewell, BlackRock's Fundamental Equities EMEA CIO. She's going to be with us around the open. And Federico Gonzalez, the CEO of the Radisson Group, will join us later on set. If you want to know what's happening in the economy, I would say ask an airline CEO or a hotel CEO. We've got one of those.
Lucky for us, we do. We got plenty of things to watch on the day because, well, it's kind of a little bit of a mixed picture. I feel like on today's show, but also in terms of the data front, the events to watch. It's Singles Day in China. Guy's very concerned, not because he's single, but because, again, of the consumer economy.
My wife is watching.
We know. That's why I clarified. This is all for your benefit. There's a Treasury market closure. There's a French budget talks that are happening as well. We're going to speak to the French foreign minister later in the show, as you mentioned. German ZEW data, foreign minister meeting over in Ontario as well. But let's bring it right back to singles data, if we can.
This is a huge shopping event.
Yeah.
I've never quite got to the bottom of why it's Singles Day. Somebody said to me yesterday, because it's kind of the first, it's the 11th, it's all the ones.
Right.
I don't know, maybe that's, I have no idea. But if somebody can clarify for me, that would be excellent. But I think it'll give us quite a good sort of sense of where the Chinese consumer is, where the Asian consumer is at the moment. So actually it's quite useful data in terms of giving us a kind of steer on that.
And we have a really interesting story about LVMH nearing China store openings as luxury demand begins recovery. And so if we're talking about some recovery at the luxury end of things, and we have been having that conversation around some of those big heavyweight luxury stocks here in Europe, and if that's telling us something useful about where the Chinese economy is and where it is more widely, because they've committed to have the Chinese consumer spend more and not rely so much on the export machine.
Yeah. Are we going to see that happening? At the moment, it's a deflationary narrative that is percolating, continuing to percolate through the Chinese economy at the moment. Can they turn that around? What do they need to do to turn that around? Even more stimulus, maybe even more liquidity sloshing around the global system coming from the Chinese authorities. something to watch out for. What else you need to know this Tuesday morning? Warren Buffett says he is, quote, going quiet. Apparently, that's what the British do, marking the end of an era for one of the world's most watched investors. In a letter, the Berkshire Hathaway CEO, who is stepping down from the role at the end of the year, says he will stop writing the firm's annual letters and speaking at its annual meetings. The 95-year-old billionaire also says he will give more than $1.3 billion to his family foundations and plans to accelerate donations while he is alive. Turning to tech, CoreWeave shares dropped in after-hours trading after the company reported narrow profit margins in the third quarter and cut its forecast. The firm is part of a group of companies known as NeoClouds, which rent out access to powerful AI chips. The disappointing earnings marks a setback for CoreWeave, which is racing to keep up with the AI boom. Take a look at the numbers, though. What it tells you is that there's still an epic amount of demand out there. They just can't satisfy it. Let's turn our attention to what is happening in India as well. An explosion near the historic Red Fort in India's capital, New Delhi, has killed at least 8 people. New Delhi police says the blast occurred in a moving car on Monday night, and the cause is under investigation. High alerts have been issued in several states and at airports across the country following this incident.
Coming up on the programme, we'll dive deeper into the global trade as the US administration works with Switzerland and with India on new deals. Plus, we'll get the latest on the French budget talks and fiscal woes with Benjamin Haddad, France's Minister for Europe. Up next, we speak exclusively with the Munich Re CFO about the reinsurer's third quarter earnings. If you have questions, get involved in any of these conversations around this desk. IB plus BBTV Go. That's the function this morning and every morning. This is Bloomberg.
We also see a labor market that's softening and wage growth that is moderating. So you're really not going to see a lot of pressure coming on the cost side of labor. So I put those things together, and we don't want to make the mistake of holding on too long for rates, only to find out we injure the economy.
It's very important that we tread with caution here. I think there is limited room to ease policy further without policy becoming overly accommodative.
Different views from San Francisco and St. Louis. What is the Fed going to do next? What is going to happen as we work our way towards the end of the year? Well, actually, maybe some of the data will give us a clue as to what is going to be happening. What are we going to see next from the central bank? Well, data is going to be important. And as I say, well, as Val said yesterday, maybe we'll get a deluge of it by the end of the week if the shutdown ends. The market certainly responded to that yesterday. Big bounce in tech. Are we going to see it continuing? Futures aren't looking so clever this morning, Valerie Teitel.
Yeah, we are looking at pretty fragile when it comes to that equity rally from yesterday. Those NASDAQ 100 futures are in the red, down around 0.2%. But, Guy, you need to put this in context that yesterday's rally was so strong, especially when it came to those tech shares. So I'm not so sure how much that this move lower is really telling us. Yesterday, the NASDAQ 100 was up 2.2%. Its best session in 5 months, and that favored company of everybody, Nvidia, was up near 6%. Its 4th best session of the year. This government shutdown has really given a lot more confidence to have this tech rally bounce back from last week's weakness. Now, watch out. As you mentioned, we could get the resumption of U.S. data, and that could possibly change the narrative when it comes to where this equity market is going. But I want to talk about some trend lines because I think this is key here for when it comes to momentum. We did see the S&P 500 last Friday dip below the 50-day moving average for the first time since April. But since that dip, we have bounced back very strongly. I think this has given a lot of confidence to the equity market that the weakness of last week might be in the rearview mirror, and we're looking ahead to the resumption of the data after this shutdown. I also want to mention another asset that has been on the move higher since this shutdown. Looks like it is going to be closing at the sometime this week. Gold has really been on a front foot. Yesterday's session in gold was one of its best days of the year. It was up around 3%. Now, this is now seen as more of a liquidity play. As the shutdown has gone on for 40 days, the Treasury's checking account, also known as the TGA, the Treasury's general account, has been steadily rising in its cash balances. Now that we have this shutdown possibly coming to an end, the Treasury will be resuming those payments, releasing liquidity back into the economy, and that has been helping the gold price of late. It's on a 3-day winning streak, up near 4% over that time frame. Anna?
Valerie, thank you very much. Bloomberg's Valerie Seisel, of course. Let us get back to the earnings stories. And the reinsurance sector is in focus this week. The latest from that sector is numbers from Munich Re. We have the company third quarter EPS coming in better than expected. Profits up substantially year on year. But interesting commentary around the guidance. The firm saying it's well positioned to achieve its profit guidance, but adjusting the language around revenue. So let's get into that conversation. We're joined now exclusively by Christoph Jurecka, who is the Chief Financial Officer at Munich Re. Christoph, very nice to have you with us. Thank you so much for joining us. Can you give us briefly a sense of the guidance message that you're trying to put out there to the markets then? Because you talk about expecting lower revenue in reinsurance due to premium adjustments, but you're well positioned on profit guidance. Give us the summary.
Well, thank you, first of all, for having me. We had a particularly pleasing quarter with another strong result of 2 billion euros, and we are now standing at 5.2 billion after 9 months. So result-wise, we're very much on track to achieve or even exceed our guidance. But when it comes to revenue, our revenue is a bit lower than expected. So we reduced our guidance for revenue by 1 billion. And this is driven firstly by technical effects, so currency, premium adjustments, stuff like that. But on top of that, we also deliberately decided to let go some business which didn't meet our price expectations, margin expectations, or more importantly, didn't meet our expectations when it comes to terms and conditions. And this dampens our revenue outlook a bit, but the overall profitability of the book is completely unaffected by that. It's even improving by that.
Yes, can I ask about property and casualty and the reinsurance, the combined ratio you've reported for the third quarter for that business? Because that looks to be very much more profitable than it was last year. Is there something sustainably better about that number, or is this more of a one-off?
Well, it's a bit of both. We clearly benefited from a third quarter where we didn't see a lot of large losses at all. The hurricane season didn't affect our result at all, given there was no major landfall, despite the fact that the season overall was quite normal, but there wasn't any significant landfall in Q3. So therefore, large losses were better than expected, and we clearly benefited from that. But at the same time, also our underlying result is, I would say, at least in line with expectation, rather a bit better with a normalized combined ratio, where we would normalize for the very good large losses, even a bit being slightly below guidance. So therefore, it's both underlying and large losses.
Christoph, it's Kriti in London. Thank you for your time this morning. You talked a little bit about kind of the issues around natural disasters. I want to bring up cyber insurance in particular. We know Munich Re is a big player when it comes to that space. We're having a lot of conversations right now about security, about geopolitics, about technology, and of course the role of AI as well. Just walk us through where you think that market is going to go from here, given that we have seen some hiccups when it comes to American companies in that space, like CrowdStrike, like Palantir even, like Datadog, among others. Walk us through your thinking about the cybersecurity space.
Well, first of all, due to all the reasons you're mentioning, the demand can only go up. So there is significant demand. I think it's one of the major risks society is facing today. So plenty of room for insurance. But then at the same time, insurance needs to come at a decent price, at a proper price. And also the terms and conditions need to be in such a shape that we are able to offer not only the cover, but also the services our clients would expect from us. Having said that, in some places, the market has just been a bit too soft, too weak. Prices have not been up to the level which we would expect recently. And therefore, our exposure even decreased a bit over the last couple of years. But we're very happy to grow into that space, also given the rising demand, as soon as prices in the global market would go up again.
Well, Christoph, just give us a little bit more detail there. You said there's weakness in spots of that. One, can you just be more specific about where those spots are and what's driving that weakness?
Well, I mean, the demand, as I said, goes up because there's more and more which needs to be protected, but also the threat level is only increasing. And new technologies coming in, of course, also mean new threats. But you shouldn't underestimate those risks. And I think sometimes when prices are too low, they are just not adequate to adequately cover also the risk which we would need to have. The price we need to have to cover that risk also, given also the risk we take on our balance sheet. And terms and conditions are even more important. So one example which was heavily debated in the industry over the last couple of years already is the so-called war exclusion. So to what extent and how can you properly exclude war or cyber war from cyber coverages? It's an important requirement to make the risk insurable. But how to exactly word that is something which has been debated quite a bit in the industry. And we have been very strict in imposing our cyber wording, our cyber war clauses on our clients, because we think it's really a prerequisite to be able to insure that business. Many of the market players followed us, not everybody. And therefore, I think it's still an ongoing debate, but the industry needs to be very strict in that respect.
Christoph, good morning. Is Munich Re Asset Management big enough?
Well, absolutely. We have around 250 billion of assets. We are not only managing our own assets, but we also collect the asset volume and assets from external parties and do the asset management for them. So I would clearly say, yes, it's big enough.
Okay, so it's big enough. You think it's big enough. The rest of the industry is consolidating. Do you need to be part of that, therefore?
Well, the strategic decision we made is a slightly different one. There is clearly markets and asset classes where we are big enough, as I said, and we are able to really very well, be in that market and provide very professional services to our clients, but also for the internal assets. But then there are other markets, other asset classes where we are not big enough and we do not have the proper and specialized expertise in-house. And in those markets, we go for an outsourcing strategy. So we use also external asset managers who would help us with asset classes where we do not own the expertise ourselves. And by that, we get enough scale across all the asset classes and all the markets.
But there's no conversation internally or externally about finding a partner for that business. That is not a conversation you are having at the moment.
Exactly. The strategy we have is in-house plus selected outsourcing.
Christoph, great to catch up. Thank you very much indeed. Christoph Jurecka, Munich Re's CFO. Appreciate the time. Kriti.
All right, coming up on the program, we're going to bring you a conversation with Aaron Captain, Global Head of Economics and Strategy Research over at UBS Investment Bank. On the docket, I imagine we're going to talk about the shutdown. I imagine we'll talk about tariffs, the geopolitics. I mean,
he's about to have a really busy week, isn't he?
He is.
Potentially, his week is about to get really quite manic as we try and plug in all these numbers that we could be getting out of the US economy, backfilling a little bit. But how much of that data can we trust? What is it going to tell us?
Yes.
Is it reliable? Is it useful in terms of telling us a picture about where the Fed's going and the economy's going?
Yes, I mean, I know that services is outside the current tariff conversation to a large degree, but I imagine at a UBS conference there might be quite a lot of interest and chatter around a change in the tariff rate for Switzerland.
Yeah. The tariff rate, the FDI, the investment deals that Donald Trump is talking about, the consequences of the Supreme Court. I'm sure there's some oil conversations happening in the background as well.
Yep.
I'm sure Singles Day will come up, Guy.
Of course it will. It is Singles Day. It is Armistice Day. There are a lot of things going on today. We are watching very carefully what is going on. There's plenty of volatility events that are on the agenda at the moment. We're watching that tariff story. We're watching what is happening in the United States. Today, here in Europe, we've still got to price in a little bit of the bounce from the United States. It's going to be interesting to see what this market looks like. Let's call it half an hour into trade. Anyway, the opening trade is almost upon us. Half an hour away. This is Bloomberg. So 30 minutes to go until trading starts here in Europe. Cash equity trading. Yesterday's session was unbelievable stateside. That felt like a big bounce for a reopening of the government. I think people probably just wanted to buy the dip maybe, and that was the narrative coming in. Just needed an excuse, and it was a big bounce. Today, we've got to price some of that into our European space this morning. We didn't get all of it yesterday, and as you can see, the FTSE is up by 0.9%. Just be aware of the fact that the pound is down this morning on the data, but the CAC 40 is up by 0.5%. The Euro Stoxx 50 up by around 0.3%.
Yeah, UK assets no doubt doing something related to the wage data, as you say, Guy. The bounce in US stocks didn't do much for Asia, so we'll see how much translates into the European session. In terms of the bond markets yesterday, they certainly were not having a good day on the back of the strength of equities, and perhaps we'll see something similar today. We see red across the board when it comes to those European bond markets at the open, but no great movement there. Kriti.
In the meantime, lots of economic news to digest from around the world. UBS has the annual Headline European Conference in London today, featuring debates with industry leaders, policymakers, and investors who, of course, are going to be having those conversations. Our very own Francine Lacqua is there now. Francine?
Kriti, thank you so much. Yes, we'll be broadcasting from here throughout the day. It's a great event with about 2,500 participants. Now, one of the men that is, of course, spearheading all of this, Aaron Captain, Global Head of Economics and Strategy at UBS Investment. Aaron, thank you for joining us. I mean, look, there's a lot going on in the world, and we may have the end of the government shutdown. What happens after that? Just like data?
Yes, but first we need a release schedule, right? So there was sort of a similar situation in 2013. I think the BLS released a release schedule for all the data coming out within a day of the shutdown ending. And then I think the Census Bureau a couple days after. So I think by early next week, if the House votes tomorrow, we could get a barrage of data.
Aaron, are you confident that actually the private data is more or less tracking what the U.S. economy is doing, or is there a danger that we're going to get a lot of data possibly Monday and it changes what markets think about the Fed?
So on the labor market, I think we have a decent amount. You can look at the state-level payroll data. You can look at sort of the claims data. I think we sort of pieced together what's more or less happening there. Inflation, I think, is a bit more tricky because the private data that we do have just doesn't correlate very well with the actual CPI releases. So they're a bit more uncertain, but it doesn't feel like anything is massively shifted in the private data.
And just in terms of timing, so the government shutdown ends, and then you get a release of when everything comes out within like 24 hours?
Well, so it depends on the agency. So if the House votes tomorrow, then so first you need we'll see if they have the votes. Shutdown needs to end. Then the agencies come out. They give you a release schedule. So I think the BLS will be quite quick. The Census Bureau, we'll see. But then if history is a guide, then they won't then the day after release everything, but they'll give you a schedule, and then I think by early next week everything should sort of start to come out. I hope they don't release it all the same day, frankly, because it's too much to digest. But yes, we should. I think we're going to get a barrage of data.
How do you look at the tariffs right now? I know that it feels like the market has moved on, but there was definitely a soft patch for about 4 or 5 months.
Yeah, so it's, what's interesting about the soft patch is that was sort of without much tariff transmission yet, right? So that was really an uncertainty shock. Now we have the transmission, and so when you look at, there's two aspects to that. There's the sort of global exports to the U.S. that's now really rolling over. The U.S. hasn't released data, but other countries have, so you can actually see it, right? And then you have the price transmission to the U.S. consumer. Now, that's been much lower, I think, than expected. But we estimate we've seen 30 out of 130 basis points of potential pass-through. So that's another 4 or 5 months. So those two transmission channels are going to create a soft patch, I think, for until early next year. And then by the end of Q1, it's sort of behind us.
How much of what the Trump administration set out to do have they already done in terms of changing the supply chains?
None of it. There's two aspects to it. So first, if the stated aim is to bring back manufacturing to the U.S., 25% rather than the 8% we have now, not going to happen, right? So for two reasons. So one is the tariffs are, while high, are much too low by probably a factor of 4. So you have wage differentials with emerging markets that are 10 to 1, right? So you don't have enough of a financial incentive to move production. The other issue is that productivity now in the manufacturing sector is 5 times higher than 50 years ago. So even if the trade shifts, the jobs don't really come with it. And so I think that bit I'm very skeptical. We think maybe you go to from 8 to 8.5% manufacturing employment. However, there's a political angle to this, which is all these investment commitments, and they are massive. So if you look at sort of the accumulated FDI flow into the U.S. the last 15 years, these investment commitments in many cases are larger than the 15 years of FDI flows. And so what we're trying to disentangle is, well, how much of that is real? How much is just a restatement of what was already going to happen? But so that potentially that could actually lead to some investment if that money actually shows up.
I mean, there are these opposing forces in the world with also a lot of deflationary pressure in China that's maybe a lot stronger than we think. And then you have, of course, AI and the technology bet propping up also the U.S. economy.
Yeah.
Like, when do they come to a head?
Yeah, well, so first of all, on the U.S., I mean, it's just extraordinary that I think 9 companies are driving, all of the increase in U.S. investment, half of the increase in global trade, and then sort of, 3/4 of the increase in the U.S. equity market cap. Nine companies, right? So you're actually seeing it sort of everywhere in the data, but it's very much the U.S. is consuming all this tech, Asia is producing all the tech, right? And so now in China, what is interesting is that, for the last couple of years, we've talked about the property slump and now we have anti-involution, but the big story, I think, is that the new economy sectors are now, I mean, they're only 15 to 20% of GDP. They're already contributing 1/4 of GDP growth, and they're actually neutralizing all the weakness we've been talking about for the last few years. And so what you see in China is not so much, they're not obviously they're not building big data centers like the U.S. is, but they are actually, I think, going to be very rapid in diffusing this technology and doing something with it. And I think they're ahead of most other countries there.
But if you look at the AI, is it in a bubble? I mean, the definition could be that actually, a bubble is when you could get fired for not owning the stuff. And so until it pops, you're like in a little bit of a trouble, a spot of trouble.
No, so look, I think it's way too early for that. So inevitably, when you have, this is potentially a new general purpose technology. So if it's like the 1990s, you're going to have 4 or 5 years of investment. Eventually, we figure out what to do with it. It diffuses. Now, everyone's going to try to guess who's going to win from this technology, and there's going to be some misallocation of capital because we don't actually know. But we're really very early days in this sort of process. So we've now seen 2 quarters of material sort of investment in the technology sector in the U.S. In the 90s, it was 4 to 5 years, right? So this is you have to upgrade the capital stock before you have the technology in order to then diffuse it, right? So that for us is maybe 3 to 5 years away. We're starting to bring it into forecasts. We've now lifted our U.S. potential growth forecast for 2028 to 2.5%. Like, that's a big deal for us. But that is AI. I don't think it's that far away.
Aaron, there's a lot of focus, of course, on the budget in the UK come November 26. How often do you get asked about that? It feels like it's a very difficult plane to land.
Yeah, look, I don't know any more than anybody else does. So so obviously we get asked a lot because it has an impact on the Bank of England. I live here, so I expect my taxes to go up. Look, so everyone has a guess about what's going to happen. I don't think it's. I think for the market, the takeaway is sort of, if you take a bond market angle, what you care about is that the government is trying to still balance books, and I think there's sort of at least there's sort of a fiscal restraint there that I think is very beneficial to the market, right? Now, how you achieve that restraint, of course, is political in terms of what taxes do you raise or what things do you cut. And so we'll see, what the government does. It looks to me like the manifesto is, something has to give there. Let's put it that way. It makes total perfect sense to me. I mean, I don't think they can keep doing what they're doing. The Bank of England has explicitly said if they don't repeat what they did last year, we're going to have 50 basis points less inflation. It's going to make it easier for us to cut. I mean, I think so. We'll see whether there's a coherent package, but we don't know anything more than anybody else.
Do you think the Bank of England cuts in December?
So we've now changed our call to say yes, they will cut in December. We thought it would be later, but that was a big dovish shift at the last meeting. So I was quite surprised based on effectively one data point. So there seems a desire to cut. And it's a bit odd because other than the budget, we're not going to have that much more data by that meeting. So, Bailey's the swing vote. Otherwise, it's 50-50, and it looks like he wants to cut if the data's okay. So yeah, if the data's okay, he'll cut.
Aaron, thank you so much for joining us. Aaron Captain, their Global Head of Economics and Strategy Research at UBS Investment Bank. I'm going to send it back to you in the London studio, and of course, we'll have plenty more, Guy, throughout the day here from the UBS Euro Conference.
Looking forward to all of it. Francie, thank you very much indeed. Really useful conversation with Aaron. As you said, we'll be back to UBS a little bit later on. Let's turn from Switzerland to Luxembourg. The country's finance minister is joining us around the table, Gilles Roth. Thank you for your patience, sitting there, listening to that conversation that we just had with Aaron Captain. In some ways, he raises some really interesting issues that Europe has got to face at the moment. And I'm wondering what message you're bringing from the kind of the heart of European finance to London today about what Europe needs to do to compete with the AI boom that's happening in the States, the investment story that is going on there. What is the message?
I think the message is that we have to keep up bridges, that we have to avoid the fragmentation of global trade. That is the message, and that Europe has to focus on itself, to seize the opportunities, but also to act as a bridge builder with other regions in the world. Europe should be open to the rest of the world, and I think we have to bring forward and to assure that growth will apply globally.
The thing about Europe is, and you talk about Europe dealing with itself at the moment, Europe is this massive market, this rich market, this unbelievable story that isn't able, from a finance point of view, to be able to compete with what is happening in the United States. The US has this amazing financial market story that allows it to power its economy, to invest in its economy, to deliver innovation. Europe should have the same, but doesn't, and we continuously have this argument. You're the Luxembourg finance minister. What can we... Why is it taking so long to get to that kind of a situation? Why don't we have cross-border banking? Why don't we have cross-border finance? Why don't we have all this stuff that would allow us to deliver the kind of economy we see stateside?
I think you're rightly addressing the right issues. And we have to implement what has been outlined in the Draghi and Letta report.
Yeah.
So to implement the Savings and Investment Union, and to reduce red tape in Brussels, to have better regulation rather than more regulation, to work on common rules and to apply them with any gold plating in the different member states, to have a cross-border approach and to work together.
Why don't we have it? Why is it taking so long?
I think there should be more political pressure on the European Commission in Brussels, and that is what the head of governments are doing in the European Council, and that is also what the finance ministers are doing in the Eurogroup as well in the ECOFIN Council.
Good morning, Minister. But aren't you yourself pushing back against some elements of that European project in the sense of common supervision, central supervision around specific financial markets? You're pushing back against that. You think there's a different problem, but you're pushing back against the urge to centrally supervise.
You have to make the difference. We should work on competitiveness, and competitiveness is common rules, applying them in an easy going way. And that is not reduced to an institutional question which is linked to centralized supervision. Centralized supervision will add some more costs, and we have to work more streamlined. That is also Luxembourg is advocating for. Luxembourg is advocating for a deeper and more integrated capital markets, and Luxembourg is advocating for convergence in controlling rules, and that they apply in all the different member states in the European Union.
Yeah. Does that stretch, that call, does that stretch to stock exchanges? We've heard from the Germans that they've been calling for one stock exchange, or at least raising the idea of having just one stock exchange for Europe. Is that something that Luxembourg takes a view on?
We have listened to this proposal, but our general approach, I must say, is deepening the capital markets union, and that is not a question of only one centralized supervision. That is the position of Luxembourg, and I think that is not the position only of Luxembourg, but that is also shared by several other member states.
And on the stock exchange, then, you don't think that's a project particularly worth following?
Every project is worth following, but finally we have to find a compromise, and that is what we are discussing inside the European institutions, and that is also that Luxembourg and others are discussing with the European Commission.
Minister, you talk about being competitive, especially with the United States, but the United States is driving the next leg of growth with tax cuts, with subsidies, with government investment. European countries are not doing that at all. Are you talking to your peers at the ECOFIN kind of group about lower taxation, about higher subsidies, about getting these budgets across the line? It feels like your primary goal to deal with that issue is simplification of rules, not adjusting some of these other policies.
I think every country in the world, especially the UK, the US, and of course the several member states of the European Union have to face huge challenges, assuring investment, facing defense spending, and also assuring social cohesion inside their countries. That is also a challenge I have to face. I have addressed the budget of the Luxembourgish government to the Parliament 1 month ago. And we have not increased in that budget the taxes. We consider to lower even some taxation as well for citizens, but also for business, because this government started 2 years ago and openly said that we need more attractiveness, that we need more competitiveness in Luxembourg in order to effort for all the social expenditures. 46% of the social expenditures of the total expenditures in the Luxembourg budget are addressed to social issues. So we put our strengths on increasing growth rather than increasing taxes.
Are you giving this advice to your peers in France, your peers in Spain, your peers in Italy?
It is not up to me to comment on the national situation of my peers. Everyone has to face, as I just outlined, huge issues, and of course.
But Minister, I'm sure, to your point, though, some of the issues that are happening in some of your neighbors are directly going to affect the economic situation of Luxembourg, with or without taxes in your jurisdiction. No?
That is right. You know, Luxembourg normally serves as a gateway to other countries inside Europe, but also from outside Europe as a gateway to Europe. And of course, the political situation, the stability of the economical situation in our neighbor countries affects Luxembourg, and therefore we are focusing in order to strengthen more and more our financial and banking center. Luxembourg is a cross-border operating financial center. We have more than 7.4 trillion euros under management in Luxembourg, and that is our strength, and we would like to use these tools in order to serve also the European economy.
Minister, can I ask you about another subject that might or might not be mentioned at ECOFIN this week, but certainly is on the European agenda, and that is frozen Russian assets and what to do with the money that is generated from them. Belgium has been pushing back against what other European leaders have been calling for. Do you expect a decision in December? Can we get to a decision? Can Belgium's concerns be faced?
I think Europe has steadfast assistance to financing the Ukraine. That is a question which is dealt by the heads of state and government, but personally I can understand the concerns of Belgium. Of course, we have to apply a rules-based approach. That means that there must be safeguards, and therefore I can understand the Belgian position. And for the timeline, I would say we would go ahead, and I'm confident that the solution, which fits the needs of all, will be found before the end of the year.
Minister Kriti, thanks for stopping by to see us. Always appreciate your time. Come back anytime. Thank you.
Thank you so much.
More than welcome. Luxembourg's Finance Minister, Gilles Rolfe. Much more ahead. European futures very positive going into the start of trade. A little bit to price in still from yesterday's session. We'll deal with the details when we come back. This is Bloomberg.
Welcome back. This is the opening trade. Just 9 minutes until the start of equity market trading. Perfect time to speak to our Markets Live executive editor, Mark Cudmore. Mark, European futures pointing higher. US futures, though, don't look quite so pretty, pointing a little bit lower. Is the benefit, the risk on from the shutdown, is that limited? Is that shutdown disappearing, I should say? Is that limited and done?
I think, Anna, that the price action is quite worrying despite the gains. And what I mean by that is that we seem to be very jittery and moving very rapidly on relatively low volumes. The shutdown resolution, which we expect this week, will obviously be good news. The two reasons I'm a little bit kind of qualify that positivity is that we rallied much further than expected yesterday. We kind of gave back a lot of those gains very quickly on almost no news today, which just shows these markets are jittery. And then when you go into that shutdown resolution, I think there's an assumption that the House passes it first time around. That's not necessarily so clear. There might be a little bit of a, buy the rumor, sell the fact episode around it. So I find the price action not very encouraging. The structural story is the AI theme is still strong. I still expect fresh records for stocks in the coming months. But I'm not convinced that the pullback that started 2 weeks ago is fully exhausted yet, and curious about that for the next couple of weeks.
Mark, you seem to be spending an alarming amount of time looking at crypto at the moment. This is a whole new Mark Cudmore, and I'm fascinated to kind of get your take on what you see happening there.
Yeah, and probably too much time. It's a great kind of call out because half my team think that, I'm probably looking for a signal where there might not be one. Having spent too much time analyzing it, I think that the conclusion is the direct pass through from crypto to the rest of the macro world is pretty minimal. But the indirect pass-through is definitely relevant. I think that the impact on the retail sector, on the wealth effect, is quite large. And I think that if you're going to have a deepening correction in the crypto sector and digital asset treasury companies and all the related kind of crypto sector, digital asset sector overall, then I think that will hurt some of the key retail names in tech as well, and therefore impact the broader stock market, even though the direct wealth transition is not the same. The main investor base does not overlap too much, but it still matters. And the reason I then look at crypto, even though it's less relevant, is that it seems to be the leading indicator. It seems to be the most high beta, so it might give a slight lead when sentiment is turning.
Mark, I want to circle back and end the conversation with the shutdown question. If we do start to get more data prints come out, how many data prints do we need for a clean read?
I think the data is going to be clouded for months, and it's one of these classic cases that every data print is going to be interpreted through the bias of the beholder, of the reader of the data. I think it's going to be that opportunity to spin it either way. The fact is the private sector data we've seen in the economy shows that the economy is doing okay. Sure, it's a K-shaped economy, but it's not collapsing in recession anytime soon.
Yeah. All right, Bloomberg's Markets Live's Mark Cudmore, we thank you so much. We are a few minutes away from the opening trade. Futures are in the green. This is Bloomberg.
Tuesday the 11th, good morning. You want to know why European futures are higher? Let me give you Exhibit A. This is the session yesterday on the S&P. Europe went out there at session lows. We then rallied into the close. You had Palantir up 8%. You had Nvidia up 6%. It was quite the rally. People clearly wanted to buy the dip. A little bit of context this morning, though. US futures are lower and going nowhere in a hurry this morning. So how long can Europe hang on to the gains for, I think, is now an open question. That's the story I think you want to watch for the rest of the day. But this morning at the get-go, Kriti, things are looking good.
Yeah, a catch-up trade that we're seeing across the board. And I think this one's interesting, though, because you are starting to see some divisions underneath the surface. Euro Stoxx 50 futures higher by 0.3%. But your outperformer this morning is actually right here in the UK, higher by 0.9%. There's some data questions here that we got. There's potential easing that is priced into this market potentially this morning, not to mention some very sector places as well. The DAX, on the other hand, Anna, virtually unchanged at the moment. I think this divergence that you're seeing is really crucial.
Yeah, absolutely. So we'll certainly keep an eye on UK assets, Kriti, and that leans into one of the sectors and individual stocks that we're watching this morning. So we'll start there in the middle of that board, UK Housebuilders. I mean, to be honest, watch anything that's related to the UK domestic consumer. We've had weakness in the labour market data, which has prompted markets to price in more cuts from the Bank of England. Is the data not bad enough that throws people off thinking that could be a good thing for UK housebuilders? Maybe that's the case. So we'll watch to see if they go higher at the start of trade. LVMH in focus. We've had some excellent reporting around LVMH nearing a China store opening, or some China store openings. Luxury demand rebounding seems to be a bit of a theme as we've gone through this year. And Swiss stocks guy in focus as we get closer, it seems, to a reduced tariff rate for Swiss exports.
How do we price that in? What's it going to look like? It'll take a while to get the Swiss market open this morning. We'll bring you those numbers when they get there. Let's talk about how this open is looking at the start of trade. London, I suspect, is going to be influenced by the data this morning, which is driving the pound lower, which will drive the FTSE higher because of the translated earnings story. So that is one factor why you may see some outperformance. Keep an eye on what's happening with Vodafone as well. The Spanish market is up by 0.3%. The Stock 600 is up by 0.2%. There is a catch-up trade here that we need to factor into our thinking. So where do we go from here, I think, is the more interesting question. US futures are currently negative, so just bear that in mind when you look at the numbers out of Europe. You're basically looking at yesterday's session over in the United States, here in Europe this morning. The CAC is up by 0.3%. I'm going to assume that the DAX and the SMI take a little while to get going, but I think there's some interesting stories buried within them. We'll come back to those in just a moment, Kriti.
Absolutely. Well, one of the key characteristics of yesterday's trade was this idea of technology, of course, driving the biggest moves. But you had other defensive moves in there as well. The idea you had healthcare, you had gold stocks as well that were moving higher. It's a similar story in today's trade as well. You're seeing green across the screen, but the outperformers are really the defensive ones. I think that's why I'm quite keen, Anna, to wait for the Swiss index to open, because not only are you going to get the healthcare read through, the Swiss stocks tariffs read through as well, but also perhaps some consumer plays like Nestle in there.
Yes, I mean, we are getting maybe a little bit of the Swiss story playing in already, because just opening up the consumer products and services sector, some luxury names in there, of course, and I see Richemont's up by 2%, Swatch is up by just shy of 2%. Also, rather bizarrely, in the same sector, we see Barratt, Homes, Taylor Wimpey, so some of the UK house builders also benefiting, so from those two separate stories entirely, but rate cut expectations in the UK on the rise. Lower tariffs expectation around Switzerland, both of those stories then coming together to push up stocks in consumer products and services. Telecoms is also higher, up by 0.8%, and Vodafone is the standout gainer. It popped up 5% at the start of trade. It's now up by just 2.8%, but this is a business that has reported numbers this morning. Returning to growth in Germany on wholesale revenue seems to be the top line from our reporting team about what it is that's going well over at Vodafone. Maybe appropriately on a day like today, we do see the defence stocks down. Rheinmetall is the biggest weight on the market this morning in terms of the stock 600, but Leonardo is soft. You've got Thales soft as well. Saab is down. BAE Systems, all of those. If I'm looking at a sector that is moving us lower this morning, it's probably actually the defence stocks that are under pressure. It's a fascinating one. Do valuations... Does the weight of valuations matter from sector to sector? Let's get a little bit more expertise on this and bring in Helen Jewell, Chief Investment Officer for Fundamental Equities EMEA over at BlackRock, joins us around the table. Earlier this morning, Helen, we saw SoftBank come out and talk about that they are actually had sold their stake in Nvidia back in October. And I think it brought up the question of, is this a kind of tell? Are they ahead of the game of some sort of bubble, pop, pullback, you name it? But then you see a session like yesterday where technology is outpacing everyone else. This morning you're seeing defense, which is also on very lofty valuations, pull back. How do you think about how much weight investors should be putting on the topic of valuation?
Yeah, great to be here. And valuation is always top of mind for everything that we look at. It is really important. And at the moment, what you're seeing, particularly in those AI names, is that they are priced for a certain level of growth to come through. That they're not crazily expensive if you assume the growth is coming through. But anything that brings in any kind of nervousness that growth isn't going to be delivered, you see some big rotations out of those names. But then, as we saw yesterday, quite quickly we see them rebounding. So the valuations don't look crazy, but they do if there's nervousness on the growth story. And that's why I think the AI story, of which we do remain bullish and we do think that there is a lot further to go, it is likely to be a volatile ride. I mean, someone said to me, I think it's a famous saying, you know, volatility is the price of entry to the market. Maybe when the ride is a little bit higher and you can get double-digit returns almost everywhere globally, the cost of entry is that bit higher. Defence maybe is slightly different. On the defence side of things, although we do remain still positive on the defence story, there perhaps is less in terms of the upside as there is to AI. And I think what you're seeing there is always the case that you have to rotate capital from somewhere. You know, if you are going to reinvest in perhaps other parts of a portfolio, where we're seeing a lot of that capital come is stocks that have done very, very well year to date, and defence is certainly in that group.
Last week, on that same topic, last week we saw the S&P 500 drop 4%. It was the start of a new month, so perhaps just flushing out some of these positions as well. But I think it brought up again another question of if a pullback, if a retracement in the stock market is the equivalent of a pop. How can you tell the difference?
So I think a pop is certainly something which has a much more persistence to it, and more something we're all looking at a huge amount this time versus previous times is the impact of the retail investor around it. Now, that is going to be absolutely key. If you start to see the retail investor really losing that confidence, the nervousness is that you will start to see a bit of a vicious circle in terms of downplays. For fundamental investors, however, Kriti, that can be a real positive because you can buy things at that much, much lower valuation. If we think, to Anna's point, like talking about some of the luxury names that we've seen, where you saw a real pullback earlier this year, a significant pullback, if you stuck by the fundamentals, those are the names that are actually starting to do well in Q4. So that will be actually key. I still wouldn't see that it would be a pop. I still think this is something which has got a multi-year duration, of which it's more a case of how bad might those pullbacks be at any point in time. If you'd have said on Liberation Day we would be where we are now in terms of the market, I think we would have all been quite surprised at the outcome of the market. let's not forget we've just had an earnings season that has seen a real resilience. Fourth consecutive double-digit in the US, beats by 2.5% in Europe. That is what is key for the market. So we're not nervous about a pop. It might just be that the pullbacks feel a little bit scarier than they've done historically.
But your sense is that you should still buy dips?
Very much so. In the AI space in particular, which I think is obviously a key area that we're talking about now. The key thing about that AI story is the level of capex and the level of cash flow that these companies have. It is also about this circularity around the more chips that you need, the more the chips can do, the more chips that you need, and that circularity around it. And I think also the political nature of this. AI is not just about making our work lives easier. There is much, much more to this. So very much so. Being selective within the names, that's also very, very important. This isn't just a kind of all-in on everything. And I think the non-profit tech names is still an area that we would be particularly kind of nervous about really wanting to understand.
So you're still in capital appreciation mode rather than capital preservation mode?
Yes, yes.
What would change? What would need to change for you to kind of think about altering that? Are your clients still as confident? Are they beginning to? They've made decent gains, as you say. You've had double-digit gains everywhere. Are they confident that that is going to continue, or are they like looking at their portfolios going, that's been great, I want to protect that now?
Yeah, so there's two things going on. It is the single biggest question I think anybody in our space is getting is, has this gone too far? Is this a bubble? And we're very much saying absolutely no. It is a building block of any portfolio at the moment. And in terms of, what might we be looking at, I think one of the key things is if in terms of what the chips can actually do, that starts to fade. Because at the moment, what is very different to what we saw in, for example, the dot-com rally, is it needs this continual reinvestment of capex. It isn't just a one and done in the way that line pipeline is. So that, I think, would be key in terms of things that we're watching for. In terms of the portfolio, though, and I know this is such a kind of cliche thing to say, it's a thing we talk about everywhere, the diversification of that portfolio remains absolutely critical. In any portfolio, you can't just... If you wanted the portfolio that was going to perform best, you'd have been 100% in on a couple of AI names. So I've got to accept
underperformance in my portfolio to play the game? Because
risk-adjusted returns is probably a better way I'd like to put it than underperformance.
But it is going to be underperformance. You've got to accept that because the risk around the sort of that volatility around the AI trade is going to be enormous.
Yeah.
So I have to have things that are going to do less well in order to protect my portfolio.
To ballast against it. When you've got markets that are this narrow, when you've got markets where the index itself is 10th percentile, if you want to have some balance in portfolios, if you want to avoid weeks like last week...
And you're confident that diversification is going to protect me, that correlations are not going to be extreme if we do see a rollover?
I mean, we are seeing this kind of big AI mega theme, and even gold at the moment seems to be correlated to a certain extent. But there are places that you are able to protect against it. So at any point in time, there is a part of the market that if you were underweight, you would have seen yourself be hurt. The Japan, UK Housebuilders, just to take a one-day example, luxury goods. The other part in Europe that we're watching very closely is those, we call them the sleeping giants, that haven't done that well year to date, in part because of where the dollar has been. That has now stabilised. And what you're seeing in those names is the valuations actually looking really interesting. So in a short way, yes, there is diversification within the market, albeit a lot of it is being sucked into those AI names.
And Ellen, we've talked in the past about the link between the AI theme and some of the clean energy plays in Europe, and I know that's a theme that you're leaning into still. I read a Bloomberg opinion piece which reminded me 3/4 of electricity in Europe and the UK year to date has come from clean power sources, which the writer says, 15 years ago that would have been considered science fiction. So it just shows the pace at which some of this is changing. Is that a theme that you still play from here, or has it just come so far it needs to pause?
No, that is probably the key thing at the moment. The one other thing that could stop the big AI story, I should have mentioned this one to Guy, is that there's not enough power to literally power it. And so the investment into keeping the power, there are so many great stats that you can use around it. The amount of renewable energy is equal to China in the EU renewable coming on board between 2030. So many great stats that really put the amount of power into context. So anything that helps that is going to be super supportive. We need more energy. And the energy from whatever sources it needs to be is absolutely key. I think the other thing we're looking at very closely as well is that making sure that we're not just always throwing the baby out with the bathwater. There's been a lot of negativity on software names, but actually what you often see is that you can have persistence and progress running alongside each other. The two things aren't mutually exclusive, and we're seeing this big K-shape in terms of stock performance and earnings performance. But actually really understanding those stocks that are maybe like categorized in a particular group, whether it's software, whether it is the wrong part of energy, because it's not deemed to be kind of like part of the solution. Those names can actually be trading at a very interesting, an interesting multiple. And the earnings, Anna, have been actually much, much better than we thought. Q3 earnings have been decent. They've been OK.
Yeah, so you're suggesting that some of those software names that maybe people have worried about AI competition could still have a role.
Exactly right.
And I mean, is that part of the sleeping giants narrative, maybe, around Europe?
Exactly. So all of these names, and again, for us as fundamental investors, this is where it's really interesting, really sifting through those. Where has everything just been categorized? We're seeing big sector, everything that's linked to a particular sector just seems to go up or down in the same way. So for us, really sifting through that is a really, really interesting opportunity, and that's something that we're looking at. That's something we're looking at as well.
Great stuff, Helen. Nice to see you.
Great to see you. Thanks for having me.
A lot going on. Helen Jewell, CIO for Fundamental Equities EMEA at BlackRock. Let's talk about some of those equities. Let's take a look at the Core 6. This is what we are looking at this morning in terms of some of the narratives that we're watching. Maybe some of the Swiss stocks are doing a little bit better. We're up by 0.6% on Nestlé, but it's interesting to see some of the outperformance coming through in luxury names this morning. Appropriately, maybe, the defence stocks are soft. Let's talk to Chloe Melly about what we are watching.
Good morning, guys. So Vodafone is up quite strongly this morning. We're up 5% for Vodafone after it said that it targets the upper end of its guidance, and it also returned to growth in Germany, which is its biggest market. So it seems that the turnaround that we've been seeing for the last couple of years under the new CEO has been starting to pay off, and it is being rewarded this morning with the shares up 5.6% now. Moving over to Munich Reinsurance, Munich Re is down this morning. It is down almost 2% after cutting its insurance revenue guidance. The profit actually did rise, but this guidance cut is really now weighing on the shares for Munich Re. Moving on, but staying in Germany, we've got Hensoldt in the defense space, which is also down 5.5%. It said to investors at a Capital Markets Day that it was targeting 10% revenue growth in 2026, which might seem like a good number, but that is a number that disappointed investors, and we are down quite a lot this morning. It has dragged down as well the shares of other defense companies in Europe this morning. And finally, let's move over to the chemicals sector, and Jefferies analysts have done a bunch of ratings across the sector, but we're focusing here on Evonik and Croda. They are the ones that are facing the biggest challenges, and analysts have said that trying to find earnings support within that sector in 2026 is like trying to find a mirage in the desert. So that is quite strong words, and that is dragging down those shares in those two names in particular this morning.
OK, Chloe, thank you. Chloe Melly from our equities team. Coming up, we'll focus in on another stock, LVMH in focus this morning. The luxury group nears major store openings in China in a bet on the luxury rebound holding. We'll get into that conversation next. This is Bloomberg.
Tuesday, good morning. Welcome back. Futures are pretty positive. We are still dealing with yesterday's session in the United States, which was very positive, and we've got to price a little bit of that in terms of the narrative we're watching here in Europe. The FTSE 100, though, is definitely outperforming. Some of that's to do with single stocks that we are watching. Some of that is to do with the fact that we have had the pound under pressure. But elsewhere, we're still pretty good as well. One of the stocks that is up this morning is LVMH. The luxury sector is having a good day. And Bloomberg has learned that the company is set to open major stores in China as high-end brands see early signs of sales rebounding in the world's second largest economy. For more on this, we're joined by our Shanghai Bureau Chief, Charlie Zhu. Charlie, talk us through the significance. We've been waiting for these stores to open in China. Kind of felt like it's been delayed a little bit as we've wondered what is happening with the Chinese consumer. Now we're on. What does that tell us about A, the Chinese economy, and B, what is happening with LVMH's strategy?
Yeah, what we're hearing is 4 labels of LVMH, including Dior, Louis Vuitton, are opening multi-story stores in Beijing, and at the same time, Louis Vuitton is said to be, close to opening a new store in Shanghai for Christian Dior. And this, is being read as a sign that China's luxury spending is bottoming out, showing signs of recovery. If you still remember, Louis Vuitton, LVMH, and Kering, which owns Gucci, just reported better than expected sales number for the third quarter, and that all, is being, read by analysts as a sign that the consumer spending, luxury consumer spending in the world's in one of the world's largest luxury market is stabilizing, and at the same time, some global retail sellers have also voiced cautious optimism about the prospect and recovery in one of the world's largest economies, second largest actually.
Well, Charlie, you use the word stabilizing, of course, in the Chinese economy. We know that there is a broader slowdown that has a lot of investors worried. How much of this recovery is sustainable? How much of it has legs?
That's a good question. Actually, there's still a lot of concerns about the prospect of the Chinese economy. The slowdown is continuing. Consumer spending, consumer sentiment remains very weak. The 1.2% jump in China's core CPI for last month, was a bit misleading, because based on what we heard from analysts, half of that gain was, coming from the sharp rise increases in gold jewelries, and the rest of the, items in the basket, from energy to housing to food, remains in negative territory. That shows, how weak Chinese consumer sentiment, it remains very weak, and one of the main reasons is the property market. Property prices are still declining, and the property accounts for vast majority of households are relying on property as for income or for wealth. 80% of the wealth come from from property. And the decline has been going on for 5 years, and there's still no sign of bottoming out. So that really hurt consumer sentiment. People are not willing to spend because of the wealth keeps shrinking.
Yes. Now, when we speak about gold prices on this program, we're often talking about the role of the central bank in China buying up gold. That's been a theme for a while. But here, of course, there's a link into the luxury sector. Weave in the gold story for us, Charlie.
Yeah, both gold is compared to, people are buying gold in China because, that's considered a safe haven asset, right? And the bond market, was performing very poorly this year, and the stock market just, started to rebound. For a long period of time, gold, has been offering, more returns to investors. So there is and people are just following the herd mentality. Who knows, how long this is gonna last.
All right. Bloomberg Shanghai Bureau Chief Charlie Zhu walking us through the story when it comes to luxury and, of course, how China's economy plays a role in it. We thank you so much. Let's go to another Bloomberg scoop. We understand that Switzerland is close to securing a 15% tariff on its exports to the United States. The deal, which may be concluded within the next 2 weeks, would be a relief after Switzerland was hit with a punishing 39% levy over in August. Elsewhere, President Donald Trump says the United States was getting, quote, pretty close to a trade deal with India.
We're making a deal with India, a much different deal than we had in the past. So right now they don't love me, but they'll love us again. We're getting a fair deal, just a fair trade deal. We had pretty unfair trade deals. They're very good negotiators, sir. Just you have to take a look at that, if you would, please. But we're getting close, Scott. I think we're pretty close to doing a deal that's good for everybody, right?
For more on this, Bloomberg's trade czar Brendan Murray joins us around the table. Brendan, let's start with Switzerland, then we'll get to India. What do we know about this deal that takes a tariff rate from 39% to 15%?
Well, we've been talking about a Swiss deal being close for several months now. Switzerland has been to the altar and gotten disappointed before, so I think we have to sort of put that into context. What we do know is that both sides are coming closer together. We heard U.S. Treasury U.S. Trade Representative Jameson Greer say last week that Switzerland's pharmaceutical companies were offering to produce drugs in the U.S., that things like high-tech, high-value manufactured goods like aircraft parts that are made in Switzerland could be produced in the U.S., and that he even said gold could be smelted. Switzerland has a lot of gold trade with the U.S., and that gold could be smelted in the U.S. So the U.S. Administration sees Switzerland moving more and more in their direction toward producing the goods that are produced in Switzerland in the U.S. How that deal comes together and whether Switzerland can get from 39% down to the rest of the European Union that has 15% is still the big question.
India?
India, we have also been talking about being close since March.
Yep.
They were initially a front runner for one of these Trump trade deals, and talks have dragged on and on. It's important for India to lower that rate because their rival economies in the region have negotiated lower rates in the interim. So India has a lot of trade with Russia. Trump wants to reduce its reliance on Russian oil, Russian military hardware, and wants to see some of that business come to the U.S.
Great to see you. Thanks for stopping by to see us. You're going to be a busy man. We're going to watch the central bank story evolve. President Trump, certainly a lot on that subject over the last 24, 48 hours. I want to turn our attention, Brendan, to what is happening with UK assets and figure out what is happening there. We've got a big move in the pound this morning. You've got a big move in the UK 2-year as well, which is kind of coming up against, I guess, the top of its recent range, so it's going to be interesting to see what happens there. So yields are moving lower on the fact that we've basically got UK unemployment at the highest levels since COVID. The jobs market is beginning to weaken. Is this enough, really, to tip the governor over into the cutting camp? We didn't see that last time, but people are now increasingly pricing in December as an almost certain move now. But we've got to get through the budget.
And it seems as if that, the data, the excuse this morning is the data and the weakness in the labour market story. And what's interesting, diving into the Deutsche Bank research on this subject, if you don't trust the overall headline unemployment data, and there has been a lot of issues with it, they're pointing towards redundancy data, pointing toward HMRC payroll data, payrolled employees data. All of that is pointing towards something softer. And interesting in terms of sectors, pulling payrolls down, it was a combination of weaker hiring in retail, but also in information and communications sectors. This is tech.
The problem is we're about to have a budget that is going to be anti-growth, is going to raise taxes, is going to make it harder to employ people in this country.
And the last budget was deemed to be anti-new employment, at least, wasn't it? Because it provided a disincentive to employ more people with the higher national insurance charges.
So how do we get out of it? What is it that delivers us from this? Is it going to be a series of aggressive rate cuts that are now going to be required, maybe from the Bank of England, in order to kind of stabilise and offset the situation?
And that's what got priced in immediately after we saw the data, right? More 28 basis points worth of cuts showing up into that market.
And that had an impact on stocks. So we see anything exposed to the UK consumer going a little bit higher. So some of the builders in the UK up by more than 1.5% in this morning's session as a result of that weaker rate story. Coming up on the programme, we're going to be speaking to Federico Gonzalez, the CEO of Radisson Hotel Group. Lots to talk about in terms of the travel and tourism sector. Is there anything K-shaped about the UK tourism market? US tourism market right now. We'll talk about that. Where's the next hot place to go to? The next really in-demand place for global travel? We'll talk about all of that. That's coming up next. This is Bloomberg.
Welcome back to the opening trade. About 30 minutes into today's session, green on the screen across the board, but the real outperformer is right here in the FTSE 100. It feels like today is a little bit of a catch-up trade kind of day, but when you look at the movers of the FTSE 100, a lot of this is tech-driven, a little bit of healthcare in there as well, Guy.
Okay, let's talk about what is happening with the market internals and figure out what is going on here. Look, there's a couple of things you want to note, one of which is you're seeing a definite outperformance to the upside, 419 up versus 151 down. However, and this is a big however, and Mark Carbon was pointing this out a little bit earlier on, what we are seeing at the moment is moves on low volume. This is an unconvinced market. This is not a convinced market about where we go, which direction, up or down. I think the kind of the intraday story kind of speaks to that a little bit. In terms of where we are seeing some gains today, tech is on the front foot. Unsurprising. Did you see what happened yesterday? Palantir up 8%, Nvidia up 6% in yesterday's session. That's feeding through here in Europe this morning to an ASML move, which is up by 1.8%. You're also seeing gains in some of the pharma stocks this morning, up by 2.35 for AstraZeneca, and the luxury names are on the front foot as well. LVMH. It is the 11th, and I keep making this point that maybe it is appropriate the defence stocks are down, but they are definitely down today. You're seeing rotation out of names like Rheinmetall, Leonardo in the defence space. Saab is down. BAE Systems is also tracking a little bit lower as well. Rheinmetall in Germany down by 1.7%. Leonardo down by 1.46%, making also comments about UK defence spending and helicopters this morning as well. The other stock I want to mention is Munich Re, which is down as well. A little bit of a disappointment. We spoke to the CFO a little bit earlier on in the session to talk about what they see in their numbers and maybe a little bit of a miss in some areas to the downside, Anna.
Let's talk about some of the other big picture stories that we have in focus this morning then, guys. SoftBank has sold its entire stake in Nvidia, pocketing nearly $6 billion. The sale comes ahead of a rash of planned investments by founder Masayoshi Son, including an upcoming $30 billion investment in OpenAI and a $1 trillion AI manufacturing hub in Arizona. UK unemployment has risen more than expected, further evidence of a cooling labour market that prompted several BOE officials to call for an interest rate cut last week. The jobless rate climbed to 5% in the 3 months through September, up from 4.8% the month before, and the highest since early 2021. And the record-setting 41-day US government shutdown may end as soon as Wednesday after the Senate passed a temporary funding measure backed by a group of 8 centrist Democrats. The Republican-controlled House must still approve the spending package, which keeps most of the government open until the end of January and some agencies out to the end of September. But Speaker Mike Johnson said he expects it will pass quickly. Guy.
Anna, if that happens, are we about to get a deluge of data which is going to tell us about what is happening in the US economy? What is happening in the world's biggest economy is a key question that a lot of people are trying to answer right now. In my view, if you want to know the answer to that question, what's going on economically, you ask an airline CEO or the CEO of one of the world's biggest hotel groups. Fortunately, we have one of those with us right now. Federica Gonzalez is the CEO of the hotel giant Radisson and author of the new book, Working and Living Abroad.
Good morning.
Nice to see you.
Thank you.
What's going on? We're trying to figure out what's happening with the global economy. We're trying to figure out what's happening with the US economy. There's a lot of talk about K-shaped economies at the moment. Yes. It's good at the top, bad at the bottom. Yes. What are you seeing?
Okay, I think we are seeing, as you say, economy worldwide is doing differently by region. Okay, very, very different trends. I think if you look to EMEA, for example, consumer is back into travel after yep. COVID. I think we are seeing business recovering, business travel and leisure also travel growing significantly. I think if you inside EMEA, you see countries like Italy, Spain, Southern Europe is doing yep. particularly well. Germany is struggling a bit. Growth is not coming in line with the yep. economy. And I think very strong growth in Middle East, in Africa, in some of the destinations, and very strong growth in Asia. China is not yet back to the growth levels that we had in the past, but actually is slightly recovering. And I think in the US, after a year where both inbound and outbound has not been growing significantly, we are seeing a slow recovery for around 1-2%.
What do you think about this kind of idea of the K-shaped recovery? You got upper end doing very well, bottom end of the market doing less well. Are you seeing that in your business as well?
We are. I think when you look across segments and you get, for example, countries like France, for example, where actually the 4 and 5-star segment is recovering. Meanwhile, the 1, 2, 3 stars is not growing yep. as much. Now, that is also linked to public spending many times. Many times the 1 to 3 yep. Stars are more linked to public spending, workers moving around the country.
Is that true in the US as well?
It's also true in the US, yes. I think you see 4 and 5 more linked to higher end yep. Travelers and more leisure growth. Meanwhile, the lower segment is more on the normal business economy.
Yep.
Well, sticking with the theme of the K-shaped recovery, talk to us about the labor market here. Are you finding it hard to hire right now?
Yes.
Or are you hiring at all?
Well, actually we are, but actually it's extremely difficult. I have to say, and always say, and this I give an open invitation to any administration of the world to help us do it better. I think nearly in any country in Europe, for example, we know, and actually we could help to say how many people we need every year. We would get all the hoteliers and the food and drinks business of the country. We could tell any government how many people we need any simple year to fill up the jobs. And we could get organized to train them. I think, unfortunately, what we are lacking is lack of political decision to make sure that we get the right people in the right place. I recall years ago, we would be training people all over Europe. Okay, we would be getting people in Germany, people in the UK, or people in Spain, where we would be bringing people from wherever the government would say that we could bring them, and we could train them. And actually, I think that is something that I think is lacking more in Europe. I was 2 weeks ago in India, where actually the government is establishing themselves programs like this, where the hoteliers can go to training and recruitment centers, where actually you go there and you say, I need 500. You will train them, you will get them, and they will work. And I think I always say that actually hotel business is a business where in many countries of the world has been always an entry point to people into the industry and into society. Because usually, I mean, when you start, you don't need to use or master the language, but you can learn the language, you can learn the skills. So I think it's an open opportunity for whoever in the administration of any country is watching this.
Are you offering me a job, Federica?
Yes. So I'm happy. We are happy, I think, all the hoteliers to help them understand what we need. And I don't think it's that complex. Okay, to do it.
In the face of those challenges that you're seeing, really, you named India as one of the countries to address. What do you do in the absence of that? With the people that you do have, does that mean that the cost of labor goes up, that wages go higher, that benefits go higher? How do you keep the people you have?
Yes, I think actually the two trends you are mentioning are right. Costs are increasing, not only cost of the labor we employ, but also cost of energy has been increasing significantly. Obviously, we are trying, I think, all over to try to optimize any function in the back office, okay, to try to reduce the amount of labor we need. But actually, you still need the people in front of the consumer, okay, to do a good job and to train. So we are trying to cope with those costs and trying to absorb them, okay, from within to make sure that we still deliver the profitability we have to.
You talked about the different areas of your business that are growing, Federico, and you said Asia is really growing. Where are the biggest opportunities for you as a business?
Well, I think opportunities. I think we are very happy because I think beyond Asia growing very well, I think we have opportunities all over the world. Okay, I think even, for example, in more mature markets like Europe, I mean, we are growing significantly well in Italy. We are growing very well in France. We are growing very well in Spain. Also in the UK. So I think even if Europe is growing less, I think big opportunities. I think in Asia, I mean, all Asian economies are growing, and in terms of hotels, but I think there are two sectors. One is resorts are growing significantly. We are happy to have more than 170 resorts in the world, and actually we see all over Asia the resorts business growing nearly exponentially, so that's good. I think second is India, possibly one of the markets where the largest growth opportunity exists. We are the number 2 company in India, but actually we see you have 1.5 billion people.
Yep.
The middle class is growing, and actually that after the middle class growth, you have the travel, both in leisure and business. So I think India is a huge business opportunity.
Federico, you've talked about the labour story, you've talked about the absence of labour, the labour you need. One of the things that this industry looks kind of vulnerable to or has an opportunity to do is to bring in AI.
Yes.
How much are you spending on AI right now? How much do you think it's going to change your business? How does it change your business?
I think what we know for certain is that it's going to change the business.
Yes.
Okay? How, we are not yet.
That you haven't figured out yet.
No, I think there are obvious areas. You know, I was actually last week, Monday and Tuesday, I was with the Google team in New York, reviewing actually everything Google is doing, everything that is happening, and how it would affect, and what are the solutions they are building. Actually, there is an obvious area where you look to all the back office, all the administration, all the repetitive tasks we have that will be reduced, what will help eventually, you know, some of that labor scarcity that we have. But I think the biggest one is, I think is going to enable us to step change the level of personalization.
Right.
Well, when you think about what AI can bring, is identify in a much better way who is the different targets, what is the sweet spot that you need to do to step change their experience.
So how's that going to change? I'm checking into a hotel. I'm staying at one of your hotels. How's my experience going to change?
I should be knowing much better what you need and what you are looking for, and be able to offer that automatically. Today, today, and I like it, I have to say. It's one of the things I like of hospitality, so we need to see how we balance. I like also to have the intuition in the person in the reception when they look to your eyes and they say, okay, what is this person willing to do? That intuition is worth a lot of money, okay? And I don't want to lose it. But I think maybe in 50%, 60% of the occasions, you will have that nearly automatized, so we can add a bit more sugar.
So AI is a mind reader, basically.
Yeah,
that's
basically.
right.
So you have intuition.
It's a mind guessing.
Intuition plus data equals better service.
That's right. I think so. So far, it has been more intuition.
Yes.
If you apply some data, but you keep the intuition.
Yes.
What I want to avoid is machines.
Right, yes. So no automated check-in then just yet. Federico, you mentioned that the hotel sector can be an entry point for people in new cultures, new environments. And there are a lot of people living abroad in the hotel sector, working in the hotel sector. And you've written about this some 10 years ago. You wrote about this, about working abroad. You've got a new edition of your book out, and I'm interested that you've added a chapter on working with China and working in China. And I wonder what it is that you've learned over the intervening period that you thought was important to say.
Well, I think you're right. I mean, actually, when I wrote the first edition 10 years ago, I had been active more with US. With US, I had worked for Disney, I had worked for Procter, and then I had been working obviously more in Europe, a bit less in Asia. And I had never worked with Chinese. Then when I came into Radisson, I decided to spend time with Chinese and in China. And I think it's a culture that we know less. Okay? I think obviously when we have been trading and we have been, having discussions, dinners and lunches with American people, with countries from all over Europe. But I think with Chinese is less common. Okay? So I think it was worth to share some thoughts. I think the obvious one is just communication. Okay, I mean, I think when you work with a Chinese culture, communication is never direct. Okay, it's indirect communication versus Europe and the US, where the communication is much more direct, and that leads to a huge amount of confusion. Okay, because obviously it's less easy to get a yes or a no. Okay, you may get the yes and the no, but you don't know really how. Okay, and on the contrary, when you say yes or no in a very direct way, it may create some confusion. So I think there is a big part on communication, and I think there's also something that I think, from a European mind point of view, for me was mind blowing. Is if I think China, or I mean, it's very generic statement, but I think the Chinese as a population, they have a collective idea about China that is bigger than what we usually have as our own country. Okay, they think of China as something, a collective mission, I don't know if I can say, that is different to what actually is more individualistic in the case of Western Europe or the US.
It's interesting in terms of just the relationship between the US and China at the moment.
Yeah.
When you hear a yes, maybe it's not a yes. Maybe it's
and if you say no, you don't know really what's the reaction.
Yeah, precisely.
Maybe they'll host their summit at a Radisson. Federico Gonzalez, Radisson Hotel Group CEO, joining us around the table this morning. We thank you so much. Coming up on the program, we speak to Benjamin Haddad, French Minister Delegate for Europe, as the government's budget talks continue. He's also, I should say, the French Foreign Minister. Lots to discuss with him. Stick with us. This is Bloomberg. Welcome back to the opening trade. About 47 minutes into today's session. Green on the screen across the board. A little bit of a catch-up trade from what we saw in yesterday's session in the United States. We are seeing a FTSE 100 that is slightly outperforming higher by about 1%. I should take that back. It is outperforming in a big way by about 1%. There's lots going on there, and a lot going on in the day ahead as well. Let's go through what's on the agenda. We have China Singles Day, so of course some of that check on the consumer sentiment over in that part of the world. The Treasury market, however, is closed in the United States. So when it comes to a market read-through, perhaps reaction around this government shutdown that we are waiting to get updates on, you're not going to see it today because, again, the bond market is closed. We do have French budget talks happening in the background. We're going to discuss that in just a moment as well, plus a G7 foreign ministers meeting in Ontario. A little bit of European data sprinkled across the day as well.
We'll come back to that story in just a moment and figure out what is going to be happening with some of those key meetings that we are watching. Let's talk about what is on Valerie Teitel's mind and where we go from here. She's getting excited. My question is, what happens with that? If the House passes on Wednesday, we then get an agenda for kind of what the next few days looks like. What are the key pieces that we need to figure out of the puzzle at this point in terms of telling us what the data, what's real and what's not?
Well, when it comes at least to the BLS, we're very interested to know when they're going to be back to work. Will it be this week? And then does that perhaps entail that we do get a non-farm payroll print on Friday? The other key thing that we're really wanting to hear from the BLS is what they plan on doing with the October CPI report that they have not been putting together since they've been out of the office.
They've got no inputs into that date.
So they do have some because they do scrape some from online. However, a majority of them are done face-to-face when it comes to data collection. So there is going to be some gaps in the data. And, I think this is going to be key for a few reasons. We've already talked about worsening data quality, not just in the U.S., even here in the U.K., has had worsening data quality. And some of these components in the CPI aren't collected every month. So if you skip a month and you have to interpolate, you essentially are guessing over a 4-month period where something has gone. And that can have ramifications for the data set for months to come. I mean, even well into May of next year. And that is especially important because we know how influential the CPI report is for markets and for the Fed on their path forward for rates.
Okay, Valerie, thank you very much. Valerie Teisel with her thoughts on how quickly we can get back to the data that markets want in order to work out where the US economy goes from here. Let's talk about another economy closer to home, the French one. French Prime Minister Sébastien Lecornu is still seeking a compromise to close-door talks to salvage the 2026 budget. Lecornu must secure a deal to avoid having to resign like his predecessors had to. For more, we're pleased we're joined by Benjamin Haddad, who is the French Minister of European Affairs. Minister, thank you so much for joining us. How confident are you that a budget is passed? What is the last sticking point here? What issue needs to be addressed?
This is a very important moment for the country. The Prime Minister Lecornu and the government has proposed a budget to parliamentarians and decided to make the brave choice to tell parliamentarians, now it's up to you to debate, to amend, and to go all the way to the vote. In France, historically, we have a tradition of having absolute majorities in parliament. And today now we look like our European neighbors, which is that we have a fragmented parliament. And so we need to find compromise. We need to build coalitions. We need to let parliamentarians decide and vote and debate. And this is what's going on right now. We had an important first part of the budget for Social Security that was voted this weekend by a majority of parliamentarians. And the debate is going through. The country needs a budget. We need to cut public spending. We need to cut our deficit. This is obviously the priority for the government. And I think right now we're seeing a spirit of compromise that's taking over among parliamentarians to move forward. And once again, in a parliament where you have no absolute majority, I think it's really important now that we just make a step towards one another for the country and also for Europe.
Okay, so you sound quite positive. We'll watch those developments and see how they come to pass. Something that I know that you're perhaps reaching out to European colleagues about, Minister, is Shein, the Chinese fashion retailer. And I know that it's attracted a lot of political attention, a lot of attention generally over in the French market. And now there seems to be a call to try and get other European countries on side. What do you want from Europe or from other European partners around Shein?
Let's be clear. We in Europe should not be naive. We have rules. We have a rule of law, and it needs to be respected by every company, by every actor that decides to invest in Europe. We have a company, Shein, where you see that you can order pedopornographic dolls, you can order weapons. All of this is illegal in France. It's illegal in Europe. And so we've suspended this in France, and we've told the European Commission that it needs to implement its rules. We have in Europe, we've adopted a few years ago, the Digital Service Act, with a very clear basic principle, which is that what is illegal and impossible in the real world should be illegal in the virtual world, whether that's hate speech, whether that's interference in disinformation, whether that's manipulation of algorithm. And here in this case, once again, when you see a company that's throwing products like pedopornographic dolls on European market, it should be investigated. And if this behavior is shown to be illegal, it should be fined and heavily fined. So what we're asking is just for the European Commission to implement its rule and to defend and enforce its rule of law.
Minister, is that a Xi'an-specific concern, or is there a national security element here? I ask this in the context of the fact that in the last couple of days we've heard from the Dutch government that is starting to resume some of their relationship with China when it comes to exports of chips deliveries that are coming into the country. Let's broaden out the conversation. In terms of the relationship between France and China, do we see some of the tensions being abated, or are there still sticking points?
You know, ever since 2017, and the speech that President Macron gave at Sorbonne University, our guiding principle has been the sovereignty of Europe, and the idea that Europe should be open, should have allies and partners, but it should reduce its dependencies on technology, dependencies on the military, dependencies on energy. And right now, as you see Europe under pressure, trade pressure from the United States, the war of Russian aggression against Ukraine, and the threat from Russia on our continent, and of course the economic pressure from China with overcapacities in certain products. I'm thinking, for example, of steel, of electric vehicles that are being sent to Europe. Europeans should not be naive and give themselves the ability to defend their interest. So when it comes to the relationship with China, we have trade relations with China, and it's important, but we should also be able to safeguard our own interest and protect our key strategic industries. This is why the European Commission last year adopted tariffs against electric vehicles coming from China that were heavily subsidized. This is why the Commission also is proposing a safeguard clause on steel to protect our steel industry when you have overcapacities that are coming to destabilize our markets and our companies in the European markets. And this is once again, you know, we need to defend our rule of law and our principles when it comes to Shein and when it comes to implementing the Digital Service Act and the rules that we've set up in the virtual world. It's always the same principle. It's about not being naive and reducing our dependencies on foreign actors. You mentioned, you know, rare earths. It's a very good example where we need to be able to secure critical materials in Europe, raw materials in Europe, whether that's you know, the transformation, extraction, you know, push and defend our industry, while at the same time continuing these talks and negotiations with other partners.
Minister, 30 seconds. I'm going to put you on the spot. You talk about strategic interests. Let's talk about the Mercosur deal as well. It looks like France is more likely to accept it when previously France has been very concerned about the agricultural impact domestically. Why the change of heart? 30 seconds.
But it's always the same thing. We've always said that we wanted to protect our farmers and we wanted to protect all of our industries and protect a level playing field. So it's about, you can trade, but you want trade to be on reciprocal ground. We've asked a safeguard clause from the Commission to protect agricultural markets. We've got mirror clauses with the very simple idea that you can't import products that are created with pesticide, with standards and norms that don't respect European standards and norms. So we are ready to open to other markets. We're ready to trade, but not to do it on an unfair playing field. And so this is exactly what we've said about the Mercosur. Same idea that what I told you about other partners.
Yeah. All right, Benjamin Haddad, French Minister of European Affairs, we thank you so much for your time this morning. We look forward, of course, to seeing you again on the program. In the meantime, these markets, green on the screen across the board, the FTSE 100, the outperformer.
For Europe, at least.
Yeah, not in the States.
Yes, not in the States. Yes, Europe is doing well. Kriti, yeah, FTSE up by 1%, and there's the domestic data there. Nasdaq futures, though, down by 0.3%.
Nasdaq futures, Bitcoin's also a little bit lower as well. The Pulse is up next. We're live from the UBS event. Hope you enjoy it. This is Bloomberg.